As you take a look in your world about how these asset dynamics are playing out, what really stands out to you? This idea that we do see real assets on the decline as much as we are, especially in oil?
With oil specifically, Brian brings up a good point. We have so much debt coming due. We're now the largest producer in the world with the U.S. So I don't really see oil going below 45. WTI below 45 just doesn't make any sense, because at that point, that's your break-even cost in a lot of these major basins in the U.S. We're the marginal producer now. So that's pretty much where that level is. OPEC matters. It absolutely matters day to day. They're roughly 40% of world production from an OPEC perspective. You add Russia, they're closer to 70. So they matter over the longer term. But in this next month, next 2 months, it's all about the U.S. It's if we get down to 45, you're going to see production shut in, prices are going to bounce.
But President Trump says we need lower oil prices and lower gasoline prices. So how does the market, how do oil producers, how does OPEC Plus, and how do the president reconcile or resolve all of that conflict?
Never want to count out President Trump. You never know what he's going to say, what he's going to try to do. He could give some type of incentives later on to some of these oil producers, give them some breaks and so on. But the reality is, just like Brian said, there's a lot of debt coming due. And when your break-even price is 45, you can't be producing at 39. So I don't necessarily agree with some of these arguments that, oh, we could be in the 30s pretty soon, low 40s. If you get there, I don't think it holds.
Now, Brian Sullivan, I know that you're still with us out at OPEC HQ in Vienna. Let's get on this discussion, because John brings up a number of the points that you just mentioned in your report as well.
Well, listen, I understand his point as well. But here's the thing. I've got a bunch of oil traders. Some of the world's biggest oil traders are sitting to my right. We were talking yesterday, talking last night, talking today. Yeah, I agree it may not be able to hold down there, but a lot of these guys right here believe that if we continue to see output where it is and demand stays where it is, and OPEC does not do much, there's a possibility, guys, that there is no deal. We've talked about a smaller deal. There's still the possibility of what an OPEC-sit or a no-deal OPEC, however you want to frame it. And if that happens, if we walk out of this building with no deal, that's when they were saying oil could possibly slide to the high $30 range. And here's the one thing that the president, I think, of the United States probably understands, but it bears repeating, which is this, guys, is that the oil and gas industry is massively related to the job market and to the economy. Oil and gas has added millions of jobs in the last number of years. Even if oil prices, John, even if oil prices stay at a point where the producers can make a little profit, that's not going to be enough for them to expand, which means job growth slows down, and the economy, especially in Texas and oil-producing parts of the country, slows down. I don't think the president wants that. I understand that lower gas prices matter, but jobs matter too, and a lower oil price means we could lose jobs. A lot of jobs.
So Brian brings up a great point. One of the things that I do, I speak regularly with talk radio programs across the country, one of which is out in the Denver, Colorado area. That is shale country, Wyoming, Colorado, and whatnot. One of the things that they have a big concern about is because jobs are so key because of the oil sector out there, yet we as consumers want lower fuel prices. So as we talk about the positioning of the marketplace right now, what is that balance? And is it tipping one way or the other between lower oil prices and fuel prices versus the jobs that it creates?
It is really such a good point, because some of these tweets we're getting from President Trump might be a little perverse in that he wants lower prices, but lower prices come with less jobs. So he may actually want that balance above 50. So as far as we're concerned, when you add in geopolitics and so on, you're probably going to be a year from now up closer to 60 because of some of that. He wants the jobs. It's a good balance. 70 to 80 is too high. Based on supply and demand, we cannot hold those levels. We can hold somewhere between 50, 60, and even as high as 65.